Here is a number that tells you everything about where the crypto market sits this morning. Between $59,000 and $67,000, buyers have quietly added more than 250,000 Bitcoin to their wallets, and according to on-chain data from Glassnode, that buying is broad-based, spanning both small retail holders and the largest whales. That is not panic. That is accumulation. On Tuesday, the 16th of June 2026, Bitcoin opened at its highest value in 2 weeks, just as Ethereum and XRP staged sharp recoveries of their own. So is this the start of a genuine turnaround, or just a relief bounce before the next leg down? Stay with me, because in the next 15 minutes we will go through every price, every catalyst, every key level and a realistic prediction for the days ahead. Let us start with the hard figures. As of 7:30 Eastern Time on the 16th of June, Bitcoin opened at around $66,287 and was trading near $66,400, up roughly 0.9% on the previous day's open. Crucially, that is the highest opening value Bitcoin has printed in 2 weeks. Ethereum was the standout, opening near $1,795 and trading up about 4.1% on the day, comfortably outpacing Bitcoin. XRP extended a powerful run, having climbed more than 9% on Monday to an intraday high of $1.29, before settling around $1.16 to $1.18. Across the board, the major coins are green, and the tone has clearly shifted from the gloom of early June. To understand why this bounce matters, you need to remember just how ugly the first half of June looked. Bitcoin plunged below the psychologically critical $63,000 level, and at its worst briefly touched $61,165. At that point Bitcoin was down roughly 30% year-to-date, a brutal drawdown that shook out leveraged traders and dented sentiment across the entire market. Step back further and the picture is even more sobering. Bitcoin today sits around $40,400 below where it traded a year ago, a reminder that despite this week's optimism, the asset has materially underperformed over the past 12 months. So the recovery we are seeing is real, but it is climbing out of a deep hole, not setting fresh records. One of the clearest signals behind this recovery is institutional money flowing back in. After a punishing multi-week stretch of outflows, spot Bitcoin exchange-traded funds recorded a net inflow of $85.8 million on the 15th of June. Within that, BlackRock's IBIT fund pulled in around $35 million, while Fidelity's FBTC saw roughly $42 million of fresh capital. That matters because ETF flows have become one of the most reliable real-time gauges of institutional conviction. When pension funds, wealth managers and corporate treasuries stop selling and start buying again, it removes a major source of downward pressure. Interestingly, on the same day, Ether, XRP, Solana and other altcoin products also attracted new money, suggesting appetite is broadening beyond Bitcoin alone and into the wider digital asset complex. Beyond the ETFs, the blockchain itself is telling a constructive story. That figure of over 250,000 Bitcoin accumulated in the $59,000 to $67,000 band is significant because it shows conviction buying right inside the zone where prices were falling. When holders absorb supply during a downturn rather than capitulating, it tends to build a sturdier base for any future rally. Glassnode's data showing the buying spans both retail and whale cohorts is particularly encouraging, because broad participation is historically healthier than a rally driven by a handful of large players. On-chain analysts often describe this pattern as supply moving from weak hands to strong hands. It does not guarantee an immediate surge, but it does suggest the selling pressure that defined early June may finally be exhausting itself. No crypto analysis is complete without the macro picture, and right now it is doing the heavy lifting. The dramatic price swings of recent weeks came amid persistent inflation data that forced markets to recalibrate their expectations for Federal Reserve interest rate cuts. When traders push back the timeline for cheaper money, risk assets like Bitcoin typically suffer, because higher-for-longer rates make safe government bonds more attractive by comparison. The flip side is that any softening in inflation, or any dovish hint from the Fed, can act as rocket fuel for crypto. For now, markets are treading carefully, watching every economic release. This is why Bitcoin remains so sensitive to headlines. It is trading less like a standalone asset and more like a high-beta bet on global liquidity and central bank policy. Geopolitics has been the other dominant force, and here too the wind has shifted in crypto's favor. Earlier in June, escalating tensions in the Middle East drove a wave of risk aversion, pushing investors out of volatile assets and contributing to that slide below $63,000. This week, however, those tensions have begun to ease, and you can see the relief reflected directly in prices. Bitcoin's roughly 2% bounce earlier in the week was explicitly tied to that de-escalation. This is an important lesson for anyone trading this market. Cryptocurrency no longer moves in isolation. It reacts in real time to oil prices, to conflict headlines, and to the broader appetite for risk. When the world feels calmer, money tends to rotate back into speculative assets, and Bitcoin is often first in line. Ethereum deserves a closer look, because its 4.1% gain on the day meaningfully outpaced Bitcoin. When Ether leads Bitcoin to the upside, traders often read it as a sign of returning risk appetite, since Ethereum tends to behave as the more aggressive, higher beta of the two majors. There are structural reasons to watch it closely. Ethereum underpins the vast majority of decentralized finance and stablecoin activity, so renewed strength frequently signals that capital is flowing back into the wider ecosystem of applications built on top of it. On the 15th of June, Ether-based investment products were among those attracting fresh inflows alongside Bitcoin. If Ethereum can sustain leadership over the coming sessions, it would historically be a bullish tell for the altcoin market as a whole. If you want the real story of momentum this week, look at XRP. It surged more than 9% on Monday to an intraday high of $1.29, and even after settling back to the $1.16 region, its weekly drawdown of under 8% has comfortably outperformed both Bitcoin and Solana. Analysts attribute the strength partly to large wallets increasing their share of the circulating supply, a classic accumulation signal, while ambitious longer-term price forecasts have resurfaced in the community. Solana, by contrast, has been more subdued, drifting in the $65 to $75 range without a decisive direction. The takeaway is that we are seeing selective rotation rather than a uniform rally. Money is moving with discrimination, rewarding coins with fresh catalysts and accumulation, and that nuance is exactly what active traders should be tracking. Let us talk levels, because this is where strategy meets reality. For Bitcoin, the region around $63,000, which acted as support and then briefly broke, now becomes a critical line in the sand. Holding above it keeps the recovery thesis intact, losing it again would reopen the door to that $61,000 low. To the upside, Bitcoin is consolidating just below resistance, and bulls will want to see a clean, sustained break above the mid-66,000 zone to confirm momentum. That accumulation band between $59,000 and $67,000 should now act as a thick cushion of support, since so many coins changed hands there. For XRP, reclaiming and holding above the $1.20 mark would be the signal that Monday's breakout has staying power rather than being a single-day spike. So what is the realistic outlook? Let me be clear that nobody can guarantee where prices go, and anyone who claims certainty is selling you something. But the weight of evidence right now leans cautiously constructive. We have returning ETF inflows, broad on-chain accumulation, easing geopolitical risk, and Ethereum and XRP leading higher, all of which argue for a near-term floor forming around the low 60s. In a bullish scenario, where inflation cools and the Fed signals cuts, a push back towards $70,000 and beyond becomes plausible over the coming weeks. The bearish risk is equally real: a hot inflation print, renewed Middle East conflict, or a fresh wave of ETF outflows could quickly drag Bitcoin back to test that $61,000 low. Watch the macro data and the flows above all else. Let us pull it all together. On the 16th of June 2026, the crypto market is showing genuine signs of life, with Bitcoin at a two-week high near $66,400, Ethereum up over 4%, and XRP leading the altcoins after a 9% Monday surge. The recovery is underpinned by real substance, institutional ETF inflows returning, 250,000 Bitcoin accumulated on-chain, and geopolitical tensions easing. But remember the context. Bitcoin is still down around $40,000 from a year ago and remains highly sensitive to Federal Reserve policy and global headlines. The smart approach is not to chase, but to watch the key levels, respect your risk, and let the data guide you. Never invest more than you can afford to lose. Thank you for watching, and I will see you in the next analysis.